Hi everyone, in this video I'm making a comparison between two popular option trading strategies. One, you can write out of the money option, which is naked short position, or you can set up a credit ratio spread, because in both these strategies we have a lot of similarities, but credit ratio spread has an advantage over the naked short position at a very different times. So we need to know when to set up the credit ratio spread to take an advantage over the market. But to explain that, I just have this flow of content. Let me first explain why naked option writing, because there you understand the importance of probability and the probability curve. Later we get into the similarities between these option strategies, because if you are an option writer, if you simply write out of the money option, you will see that a lot of similarities what you do with the credit ratio spread. Only with that understanding, with convictions, you can actually get into that particular strategy. And then I can give you some variants of that particular strategy, be it a credit ratio spread or a debit ratio spread, or even you can have a wide ratio spreads. In what way we can do that? And especially you need to know when to adapt this particular strategy. This is pretty common even for a naked option writers or even for a credit ratio spread, but this comes really handy if you play with a credit ratio spreads. At last, both the strategies got the undefined risk. So we need to know about the risk management. But when you actually play with credit ratio spread, what sort of management you can do so that you can save your a risk, or you can save your trades significantly. Myself Murugan, I'm a SEBI registered research analyst. Let me take you through in a very systematic way, but all I want you people is that the patience to watch the complete video. So make sure that you don't have any other distraction around you and you be focused till the last minute. Let's begin from here. Why naked option writing? If you look at the naked option writing, that a lot of things is actually because of the probability. You see the most of the time market settles around the current market price. You see around 68.2% market settles around the current market price. And if you look at two deviation, then you have about 13.6% on the upside and 13.6% on the downside. So which is slightly lesser probability for the market to show the wild move. But remember, there are about 2% on this and that side, close to 4 to 5% chances are there for the market to exhibit the tail risk. But the option writers are actually concerned about high probable winning. So if that is the case, that we have most of the time market settles around current market price. If you are aware of what is a probability curve, by any chance, if you from a statistic background, you can easily understand what I'm actually talking about it. But for a beginner, I just gonna take some step because I don't want this beyond the scope for a beginner, am I right? For option writers. So let me actually explain what it is. Let's say the market is now trading around 13,500. Okay, and I see there are about 3 days for the contract to expiry, for the weekly expiry, and I'm seeing 13,500 call option premium is, let's say, around it's trading around about 78, and this is trading around 74. Okay, let's say the market is also around 13,500, so we are taking a strike price of 13,500, so it becomes at the money. So if you look at this, we are having a collective premium of something which is around 150 rupees. Okay, now pay attention here. From the current market price, 150 rupees on this side and 150 rupees on this side. Okay, 150 rupees on this side. So the probability of market to within 13350 to 13650 is around 68% chances are there. Okay, by any chance, if you are not getting this probability, if you want to know why it is, then of course you have to go back and check our video which we have posted maybe a week before about non-directional trading strategies, because there you get to know how that non-directional trading strategies really works with that way. But anyway, let's cut short. Most of the time market settles in this particular area, so try to understand this. It means if you really want to make money, then you have to take the theta advantage and you have to make sure that you write slightly out of the money options and you packet those premium. That is the reason why naked option writers do exist. Try to understand that. But the only problem they encounter is if that market exhibits the extraordinary move either upside or the downside, because it depends on what they have actually written. By any chance, if they write call options, they are concerned about extraordinary bullish move. If they have written the put options, they are concerned about not just a bearish move, extraordinary bearish move, a deep cut in the market. We call that as a kind of tail risk. Okay, so why naked option writing? Because it is a high probable trade. Try to understand. If you do hundreds of trades, 80 times or 70 times you can actually make money, provided you choose the right strike price in a way, and you can be very sure most of the time you make money. So that's pretty interesting as a trader. It helps you to packet some money out of it, but you need to know how to time it well. This is a very common thing, am I right? So if you want to take it forward, similarities between the strategies. When you actually go for a naked short position, you simply take out of the money options and sell it. Okay, but as far as the credit ratio spread is concerned, you let's say with respect to call options, you have to buy a call. Okay, you have to buy a call and then you have to sell out of the money call into two quantities. Actually, net position is minus one call option, because you have still a net seller of call option. Okay, in a way both are actually common. Let me do that by showing you an actual example here. Why naked option writing? If you are an option buyer, if you are fond of just buying options, never written options, you may have this particular concern that as an option writer, you always have unlimited risk profile. Whereas an option buyer, we feel safe. But let me tell you one thing, that you might have experienced most of the time losing the premium. Sometimes even if the market takes on the directional as you expect, but you lose the premium. That's all because the option writers got a high probable chance of making that money. If you understand this probability curve, it actually gives you the reality that most of the time market settles around the market price. But of course, if you take certain parameters by which if you get the directional bias, there may be some skew, but most of the time, even we have tested over 2.5 lakh sample by taking about 6 to 7 years of data. In fact, if you want to know where we have presented, it was presented a week before we published a video about non-directional trading strategies. We have elaborated this particular things in detail. But as far as this video is concerned, the scope is limited to talk about the probability. But all I just want you people to understand, the reality is most of the time market settles around the current market scenario. So you need to know the right strike price by which you take a reasonable premium, and you make sure that you know how to handle the tail risk. If you're really good at that, then you will never become an option buyer and you live your life just by writing options. But that is also an art, especially about risk management. So it is more about high probable trade and there is a favorable theta. So this is the reason why people become an option writer. But we need to know in what way the credit ratio spread comes and shares the similarity. That is the reason why I just gonna come first explain about the similarity. So now, by any chance, if you are already an option writer, you might have encountered one thing. Let's say the market is now around 13,500 and we see that the scope for the market to go to just 13,800. What we do is simply we write 13,800 call option and we actually take the premium. Am I right? In a way, we also share there is undefined risk beyond 13,800 and the kind of premium what we get is also limited. But if you look at the credit ratio spread, that is also going to have the same behavior, because if a market goes beyond your break-even point, you will be having an undefined risk. Like naked short position, if a market exhibit a very strong bullish momentum in the field, then naturally you will be in an uncomfortable note. Let me present it with some actual thing along with the strategy builder so that the viewers feel much better, and then it becomes much easier for you people to understand it. So let me take a browser. Okay, so I'm actually taking EQSIS primer in order to practice this. Okay, I'm just gonna log into this. Okay, Now, this is just a practice portal, and those who got trained by us, and they will also be practicing in the same portal. Okay. So if I get into a set up a trade plan and I have my Nifty here, I'm taking up this Nifty. And if you look at this, when I'm actually building the strategies, just when I'm presenting this video, the Nifty current price is 13,571. And I was having a directional expectation, which is neutral, and which is 13,500 to 13,700 is the expected range. I'm expecting it. Now, if you're an option writer, most likely you tend to tell me that, Murugan, why not you can simply sell 13,700 option. If I sell 13,700 option, I get 35 rupees, 0.3 rupees. I hope the numbers are visible to you people. I'm recording in the HD mode. So if not, the numbers are not visible, you should turn on your HD or need to have a better Wi-Fi access. Coming back to this. So when you write 13,700 option, you are enjoying 35.3 rupees as a premium. That's wonderful, am I right? But if a price goes beyond 13,700, we actually lose money. Okay. But now I'm telling you that again, I'm gonna have unlimited risk profile. Look at this unlimited risk profile. That's why it is in red color. Okay. But if a market settles at current level, 13,500. So I told you something called gravity, am I right? Even if a market is quiet for one day, even if a market made just a marginal move on the upside tomorrow, I still end up getting an advantage because the premium tends to shrink, and that makes my MTM quite favorable. Am I right? That's how it is, high probable trade for me to make money. But now, as a credit ratio spread, what I'm gonna do? Think what I'm actually going to do is, I'm instead of simply selling it, I'm actually buying 13,500 call option. Okay. Now, if I have 13,500 option, I'm actually paying 124 rupees from my packet. I know that. Then if I sell 13,700, I just save 35 rupees. Which is not, I'm saving a complete premium. Now, the characteristics of this is completely different than simply writing options. I agree. But now look at this. What I'm going to do is, after buying this, I'm going to change this into two quantities. If I change this into two quantities, okay, it will start exhibiting the same character, but it is slightly beyond the scope at this moment. So what I'm going to do is I'm going to change this towards 13,600 so that you find the complete similarity. Okay. And I'm going to do it into two quantities. Now look at this, what happens. Now, sometime back we have seen that we were most likely going to make 35 rupees of profit. Now we are most likely going to make only 17 rupees of profit. Okay. That's interesting. But there is quite a good chance we can make money, which is closer to 100 rupees profit if a market settles around 13,600, or if a market settles anywhere between 13,550 or 13,650, you can actually make something closer to, a 65-70 rupees of profit, which is double the profit of what we have seen with respect to writing. So I hope it's quite a good chance. If a market settles precisely 13,600, quite a good money you can actually make at this point. And look at this, interestingly, you are still having unlimited risk profile. So that is the reason why I told you people that here also you have a risk which is beyond 13,700 only. Sometimes people ask me, you are writing 13,600, how come the risk comes only beyond 13,700? Because the profit what we made from 13,500 to 13,600 will help us to finance the loss which create out of this particular one. So the break even point is still 13,700. So I hope you people got that particular similarity. If you're not getting the similarity, you should watch the last 3-4 minutes again. Try to understand the break even point is still 13,700. Most of the time we got a good chance to make money, but the only difference what it actually makes is that it creates a bump. Okay, can you see there's quite a good mountain is created in a way that you got a quite higher profits can also be made, quite a good profits. Okay, now let me actually remove this again. Let me actually go back here, and I'm actually going to make again 13,700 into one quantity. Now look at this. Anything can happen. You will not make more than 35 rupees of profit here, but there, if you are directionally right, that 13,500 or slightly bullish note or something, now try to understand that you got a chance to make even more. But if you're wrong, if a market goes down, you're still making money because it's a credit ratio spread. So try to understand this is something which comes a bit more attractive when compared to a naked option writing, but it is not always, because most of the time we are taking only 17, which is lesser than 35 rupees. So we need to know when to adapt this particular strategy. That is also very important. Okay, so if you look at that, that is a similarities between a naked short position. So let me summarize the similarity here. The break even point is a similarity, first point. Okay, you can actually adapt that same break even point, and you can have undefined risk here also. You are having undefined risk here also, but the problem is you are having a lesser profits here, you are having a more profits. Okay, but this is absolutely neutral. Okay, but if it is neutral with a kind of bullish bias, this has a better advantage over this particular thing. So definitely it is not an apple to apple comparison, but most of the time you have a neutral with the biasness. But even if you don't have a biasness, look at this interesting observation. I'm going to just overlay the probability curve here. Okay, look at the probability curve, what I'm actually gonna put it in a way that you get to know it is actually getting better. Now look at the probability curve. I'm gonna make it here. Okay, look at this. If you have a probability, most of the time market settles here to here in a way that you get only 35 rupees profit. But look at this one. If the most of the time market settles from here to here, you end up getting maybe 17 rupees of profit, or even you can make a profit which is around 675 to 80 rupees of profit. Even the max profit is 100, which is at one pinpoint. I'm not taking it, but I hope you understand this is only 35 rupees of profit max potential. But here there is a profit potential of even 75, but here it is actually going down. It gets slightly adjusted, but you need to slightly fine tune it in a way that the bell curve slightly has its mountains also coming into the picture, in a way that it has gets an edge. By any chance, if you have a kind of bullish biasness, it becomes a fantastic. So this is how you need to know the variance of that. Now you need to know the variance, am I right? So that is the importance of variance, because if you know the variance, you get to know when to form what strategy. That's why I said the importance of variance. So we have a very common variant, which is credit ratio spread and debit ratio spread. Let me tell you one thing. Credit ratio spread is high probable trade. Debit ratio spread is a kind of low. When compared to credit ratio spread, the probability of making money is slightly low. Okay, but it is not low when compared to just buying options. It is way higher when compared to buying options, but it has a low probability of winning when compared to a credit ratio spread. But the point is, it has a wider range. It doesn't hurt you much. I'll tell you how it is. Look at this one. Again, I'm gonna take the same example. Look at this. Now it is a credit ratio spread. Why did I call that as a credit ratio spread? Because you paid 124, but you received 140. So at the time when you construct the strategy, you have actually received 140 rupees, but you paid only 124. So you received more than what you actually paid, in a way that it is a credit. So there is a gravity in your side. But by any chance, instead of selling it in this way, if you sell this, look at this. Now what I'm going to do is, I'm going to make it as one quantity. I'm going to make it 13,650. Now look at this one. I have paid 124, but I received only 122. It means I am not received a full money. In fact, this is also kind of a no loss sort of a scenario if a market goes down. But if a market goes up, you got quite a good chance to make some good money. Interestingly, you can retain that high, that the good profit for a good amount of time as well. So there is and your break even is also get extended. Look at this. Your break even is no more 13,700. You got a break even up to 13,750. It means even if a market goes to 13,750, you will not be in the loss making scenario. But sir, if you are a beginner or if you are an option writer, let me tell you one thing. First, understand the reality. It is not always necessary to keep the break even far away. Of course, if you keep the break even far away, you get a breather in order to make money. But if there is a necessity, only then you do it. Otherwise, try to take the premium from the market, which is also equally important. Okay, just by looking at too much of security, if you lose the premium from the market, then we are not doing a smart business. Now there is a trade-off. Do I need a wider coverage, or do I need a narrowed coverage? For that, you need to actually check out that bell curve, what I've told you people, to understand the reality that how much probability you have for that to happen. And if you want to understand the probability of the price to go beyond that, then definitely you can check out the most recent video, which I posted, I think 3-4 days before, that how to use the delta to understand the probability to define stop loss and other stuff. So I hope it helps you up. So now this is one strategy. Now it actually becomes a debit, and look at that, you got a wider range as well. You got a wider range as well. Okay. Or sometime what you can actually do is you can even go slightly out of the money options. So as you go out of the money and out of the money options to sell, you are actually taking a lesser premium, but you get a good comfort note. But you need to know when to use this. That I will touch upon as I move forward. But of course, you guys know the variance, right? The variance can be done in this way. Look at this. If you take both so out of the money options into 2 quantities, so you get lesser premium. So there is something called, you can go for 3 quantities, 4 quantities, but in general, if you are new to market, if you're new to this particular strategy, I recommend 1:2. Okay, if you really know what you're doing it, okay, I mean, if having acquired a good amount of experience, if there is a need for you to go for 1:3, I'm okay with that. Otherwise, there is something called gamma risk, which comes and hurts you people. So I generally recommend you people to play with 1:2. Okay, that even is equivalent to like naked option writing. So you need to understand that really well when you write options. So you can actually do all different variants in terms of doing it. So I hope it actually helps you in terms of constructing this particular strategies. So I hope this variant is clear. Remember one thing, I also recommend you to I can drop the link here. Okay, I can drop the link in the description for you people to try that. Okay, but when you log in this for the first time, let me tell you one thing, when you log into this first time, if you go to set up a trade plan, you will not be seeing anything because you have not posted any strategy, by the way. Okay. So if you simply want to build strategies, what you can actually do is you can click on something called everyone, and of course this will populate every other people. Like 16 minutes prior, we have Manohar and posted a strategy. Dasranth posted, Siddharth Gupta sir posted a strategy, Dayanidhi posted strategy. So Vikram Biswas, a lot of people have posted strategies, will also be available here. Okay, you can pick up any of their views and you can actually build up strategies, HDFC Bank and other stuff. Okay. Okay, now by doing that, what you get to know is you are also seeing something in reality. See, if you just watch the video, you will never get the grip unless otherwise you try something on your own hands. That's the reason why I'm just giving you the link for you people to practice. Okay, now I told you one thing, both share a lot of similarities and something is better, but we need to know when to adapt this particular strategy, which is very, very important. Okay, for that, I just gonna take a price actions. Let me tell you one thing, it is a gift to you people if you are available till this minute. Okay, and I'll really appreciate your patience, but let me tell you when to adapt this particular strategy. Look at this. See, we know this is a resistance. Sorry. Okay, this is a resistance and this is a support. And of course, we are expecting the price to go down, or if the market can consolidate. So that's quite a good chance the market to lose the momentum. Okay. And because there is a resistance, the market can go down. So, you can ideally go and create a bearish setup in order to make money, or you can create a neutral to bearish setup in order to make money. Okay. Because it is still in the range bound scenario. But when you see this is happening at a second time or a third time, sometime what we actually do is we can actually write naked options, right? We actually go and write naked options. Let me tell you one thing, this is not the place to write naked options. This is something which is market is on the very good trending note. Try to understand, this is a very good trending note. Okay. And if you look at that, the resistance is already broken, market is really rallying it, but try to understand the market also rallied quite a good distance. That is very important on the price actions. Number two, that maybe by looking at option chain analysis, if you look at out of the money options has a maximum open interest with respect to call options. If you see any sort of coincidence comes into the picture now, and if you have some expected resistance here, I would adapt you to build this particular strategy here. I would adapt you to build this credit ratio spread. Okay, credit ratio spread. Why the credit ratio spread is now better? Look at this one. See, this is not the video to advocate for a naked option writing, simply writing options. Okay, this is a video for a credit ratio spread. So I'm going to advocate only for a credit ratio spread here. So if you form a credit ratio spread in a way that you make quite a good profit here, Okay, quite a good profit here. This zone you are making a profit, and this zone you are going to make a loss, and that too unlimited loss. If a market goes anything beyond their unlimited loss, okay, and if goes down you get a minimal profit, which is a ratio. Whatever the credit spread you have is what you're going to make it. But remember one thing, by any chance if a market gives a breakout, market will gain momentum, okay, because a breakout happened, and market can quickly move to the up, and even it can come down, but your position will be squared off. You will be running out of money to sustain this because you have undefined risk, so you cannot comfortably hold that station. So when you see there is a possible breakout happens, then unwinding pressure can also exist. That is what I'm trying to tell you. If a stock is right at the resistance, but the resistance is not yet taken out, so the unwinding pressure is quite high if a market breaks that level, because quite a good time supply was there. If a market breaks, that unwinding pressure will easily take the price up. That time the possible gaining in momentum is quite high, okay, and current volatility is low. Remember, current volatility is low, expected volatility is high if I go wrong. But if you look at this particular one, already market is in the trending mode, so the current volatility is high, the current premiums are very high, and expected volatility may be continue to be the current volatility, or it can come down. But by any chance if you have that resistance is very much nearby, then you create a strategy in a way that you will make a lot of profits here, okay. And if a market goes down, you get some minimal profit. But if a market extraordinarily goes up, then only for that the market should have given already a good move. Market should not be at mean. Market should have been thrown out of the mean. Only then you actually form the strategy, because that is the time credit ratio spreads comes and help you a lot. So that's very important. Sir, by any chance, if you are not getting the content, I really appreciate you can actually watch it once again. Okay. If not, you can even interact in the comment section as well. So that in a way you can definitely get it. Let me now go and form that particular strategy, so that you get it pretty much interesting. Okay. Now let's take let's take a bank nifty here. Okay. Now let's take a bank nifty here. I hope you guys can see there's a bank nifty, which is a 17th December contract. Okay. Now let me filter. Anyone formed a strategy for Nifty? Okay, now let's take with Nifty. Okay, now I see all bank Nifties for the weekly expiry is what people built. I wish to set up a strategy for okay, let me take Nifty 31 December. Okay, now look at this. I'm taking this particular one. I am actually taking a scenario that the market is already given quite a good move, and of course if you see that the market is around 13,500, and I see that the market is already come towards 13,600, 700. I don't see the market to go beyond this 14,000 levels. Okay, the 14,000 level. So what I'm gonna do is I may be interested in picking up something like this way. Look at this. What I'm gonna do is I'm taking this 13,700 call option. Look at this 13,700 call option. I'm buying it. Okay, I'm not a fool to buy this 13,700 because the market's going up, but I have a very good plan of selling 13,850 option, 13,850 option. Okay, into two quantities. Now look at this. What happens if I sell it into two quantities? I'm kind of sure because I am now having 77 rupees goes my packet. So if you look at this, I'm getting 23 rupees in my favor, because I end up getting 150 rupees by writing those options. And so it means there's quite a good chance I have, okay, in order to get this 23 rupees. But remember one thing, the market is also in the trending note. So if a market attempts to go up, I have a chance where I can make even 170 rupees profit if a market falls in this range. So if a market wants to hurt me, then the market has to cross this hurdle. But if a market gets struck in this hurdle, I am rewarded with a lot of money. I'm not rewarded with a lesser money. So the point is, before I know the probability of me losing money is far away than a probability of me making a very good money. And by the way, I'm expecting market to go down because I see that the market is pretty stretched. Okay, so people find it quite different. Murugan, it is a bearish setup, and you formed a strategy which looks good money at upside. No, it is also a bearish setup because if the market goes down, I make money. But if my expectation is wrong, let's say if I'm a contrarian, because when the market goes up, I'm expecting the market to go down. I'm a contrarian trader. So it is true that the market has a tendency of extending a bit. Even if I'm wrong, my risk returns are taken care, is what I'm actually telling you people in this particular video. So I hope you people got some reasonable understanding of what I'm telling you. You should also try on your hand. And when you judge the strategies, compare the break-even points, see how much profits as a credit ratio you're getting it, with that particular one. And at last, we need to know about the risk management, which is also very important. Am I right? When it comes to risk management, you guys can do it in two ways. One is a stop loss. You can straight away adapt a stop loss, or you can actually buy out of the money options. I'll tell you what we can do it. Look at this again. I'm going to take it the same way. Okay. Now, if you really want to adapt a stop loss, okay, I already told you people how we can actually work on it, because if you definitely you should refer our previous video, because I'm keep on telling you that refer a previous video. But look at this. If you go to the EQSIS channel, if you go to our video channel, the most recent video, how to calculate a stop loss for option selling is what we have posted up, right? So if you look at this, we have said out of the money option selling, stop loss calculation. So you need to know how to do that. So I'm not going to repeat it again. I'm not going to repeat it again how to calculate the stop loss, but try to understand that you need to understand the delta. You need to understand the delta because you know that your risk is only beyond 14,000. So if a market goes to 14,000, you will be incurring a loss. But you need to understand the probability of market going beyond. Okay. But by looking at the money premium also, I see the probability of market to go beyond is quite a good, less chance. We see about 65% or 75% chances market not to go beyond. There's only 25% chances are there for the market to go beyond. But if a market goes beyond, then how much risk you can take, that you need to calculate. So I said I'm not going to repeat because already a detailed video about 23 minutes posted on that. So when there is a need of calculation stop loss, you can definitely recommend. I hope you can use that. Coming back to buying out of the money, that is specific to the strategy. So I'm going to spend time here. Think about it. Now, see, if you feel that this strategy got a risk, what you will be doing is you will be definitely buying an option which is 14,000 option. If you buy 14,000 option, it becomes a kind of butterfly. Am I right? And as you think about buying as you get into this butterfly strategy, this looks good if a market goes in between, but I feel really bad with this. Why? Because sooner you buy this particular option by paying 44 rupees, which is a very low probability for us to make money out of that buying. So ideally buying 14,000 so out of the money option doesn't help me, first of all. Then why should I buy that? That's a very interesting question. But by any chance, if I buy that particular option, it helps me in limiting my risk. That is an interesting aspect. So I'll tell you an interesting aspect. Instead of buying this, you make up your mind to buy that, but you don't buy it now. So it is also kind of a stop loss, but instead of exiting your strategy, you're going to buy that call option with a slightly higher premium. Think about it. Instead of buying it for 44 rupees, we may be interested in buying it for 100 rupees. Think about it. We are interested in buying it for 100 rupees. Okay, now if I'm interested in buying it for 100 rupees, what happens? So now if I buy it for 100 rupees instead of 44 rupees, let me tell you one thing. If a market goes towards 40,000, you may be incurring a loss of 120 rupees. I agree. You will not be losing 20. You will be even incurring a loss of 120 rupees. But the interesting aspect is, the very, very interesting aspect is this, that remember, I hope you guys with me, remember the point is, even if a market goes back to the normal note, you will still have a no profit, no loss zone. Somehow you can escape. That is the first advantage you get it. Because you will not get 129 rupees of profit. Your 100 rupees will go out, or at least 70, 80 rupees will go out. So there is a chances you can make some marginal profit, even if you buy that particular option at 100 rupees. So you can keep it in your mind that you may be prepared to buy that instead of today, you can buy later. You can ask a question, why not I buy it right away? said if you buy right away, most of the time, look at this, there's a high probability that you make this money. So there is a high probability you wasted 44 rupees. So instead of buying it now, the time when then the market shows the tail risk of market quickly moving 200, 250 points, then only we can actually think about buying it. If you want to know that this month, I think we have formed a strategy on Bajaj Financial Services with the 3-leg credit ratio spread. Last month, we formed a strategy with respect to EQSIS with the 3-leg ratio spread, ahead of events. So we make sure that there's quite a good, volatilities in presence, and then we actually form that particular strategy. Hope you people got some, a reasonable understanding with respect to this, particular one. So coming back to this, it's all actually about how well we practice in terms of taking it forward. So we have, other interesting video, which most of you people will be excited, and in a matter of another week, we were planning to launch that particular video, which is slightly goes in detail of option trading strategies. Thanks for watching this video till this minute. I humbly request you that if you really like this video, do share this video. In a way, of course, we get few more subscribers, and of course that the community support will support any creators like us to come out with some quality videos. Only then we can also come out with some frequent videos onto this channel. So thanks for you people staying with this till this moment.